Welcome back to this week's Talking Stocks podcast. Joe and Todd with you as always. Todd, crazy busy week, but we've got a little bit of a respite on Friday here. Good Friday, at least for the markets. How are you? How are you holding up over there?
It's a very good Friday because the markets are closed, right? And we can actually catch up on all the insanity that has been the past week.
It's a good Friday too, because I know you got your first shot yesterday, was it? And I just scheduled to get mine next Friday. So very exciting.
So they open it up in New Hampshire to younger people.
Yeah, they opened it up this morning to ages 16 plus, and I registered, and then I got an email from the university at about 11 this morning. This is the University of New Hampshire, saying that they were going to be putting on a vaccine clinic next week, Thursday and Friday, and I got an appointment. So my appointment through the state was going to be on the 29th, and I got bumped up to the 9th. So I'm thrilled.
It's coming fast and furious. Yeah, it was a little bit of a long line for me. It still amazes me, Joe, that there's not a center in every town.
Yeah.
The fact that I had to travel to the neighboring town with, it was probably like 700, 800 cars in line. I was joking on Twitter that I haven't waited in a line in a car for that long since I went to Pink Floyd in 1992.
Yeah. Looking at that, it reminded me of like the mass exodus from like a Patriots game or something,
Right. It's like I need somebody to hold up the line so I can drive under it or something,
Yeah,
I don't know.
Exactly.
But yeah, so got my first shot and I'm feeling fine. No, nothing yet. I got the Moderna shot. I don't know if listeners out there, if you've gotten the Moderna or the Pfizer or what you've gotten, but they say the second one is a little bit more of a gauntlet. So we'll see how it goes from here. I'll know at the end of the month. And then the other thing I was going to say, Joe, is that, I suppose next year we ought to plan this out, right? And actually film it on April 1st. So that we can do some sort of crazy April Fool's joke.
Oh, well, we're not supposed to tell the listeners about that, Todd. Jeez, we're supposed to surprise them. Right. Yeah, we missed April Fool's, but I was actually thinking yesterday, like I feel like April Fool's has like lost some of its relevance because we're so used to just crazy things showing up in the news. Like all this with all this GameStop stuff now, I don't know what we could possibly say to like fool our listeners.
Yeah, because maybe everything that we say could fool our listeners.
Perhaps. Right? Maybe we'll just release 40 minutes of just complete and utter falseness.
Right. Elon Musk makes alien contact. They buy Dogecoin.
Yeah, this time 2 ships block the Suez Canal.
Right, and we have some news on that to update listeners to. I mean, obviously last week we talked about the blockage in the Suez Canal and how that could create some reverberations. And lo and behold, Mother Nature, tide's coming in and a whole lot of shovels, right, Joe?
Yeah. The little excavator next to the big ship that made it look like a sandbox toy, but it worked. It's free. And yeah, so there was a bit of a response in oil prices this week, right?
Yeah, we had talked last week that when the news comes out, you probably see a slight dip. We saw a very slight dip, very slight, because very quickly, all the chatter swapped over to, hey, what's OPEC going to do with their guidance on, whether or not they're going to, keep the spigot open to the degree that it's open right now for production, or are they going to open it wide? They have the ability, obviously, to severely ratchet up and ratchet back up and down their production, and so they can control global oil prices. The news we got out of OPEC on Monday was encouraging, that they're in no rush, despite any kind of overhang from the Suez Canal blockage kind of slowing up oil that's being transported worldwide across these big tankers or whatever. They showed no real incentive to get overly aggressive in opening up that spigot. And I think that you will see over time that happen. I mean, you're going to have shale operators that screen very well for us in the research, by the way. You're going to see shale operators starting to open up their production to take advantage of higher prices and stuff. And so eventually you'll start to see some price moderation. But for now, we remain in that sweet spot. Energy remains a high scoring sector for us. April historically is a pretty seasonally strong period for oil stocks. And on a relative basis, the XLE ETF tends to generate a pretty nice spread to the SPX, the S&P 500, in the month of April. So it'll be interesting to see if that follows through. And if it does, then high scoring stocks like Diamondback, symbol there's FANG, which I happen to own. I like it a lot. That could go because it's a Permian player and Permian production is pretty cheap. So yeah, there's been some interesting developments in the oil front. And so far, nothing that necessarily scares me away from the basket. But again, these are cyclical, so they're rentals. So anybody who's investing in them needs to have a pretty tight leash on them.
Right. We talked about, I don't even remember now if it was last week or the week before on the show when we talked about Q2 seasonality, and then we released that, the short version of that again on Monday. We talked about, excuse me, we talked about oil and just generally energy stocks. And while everything tends to perform pretty well in April, energy stocks tend to be like toward the top of the heap with that. So definitely something to keep in mind now that we are in the midst of Q2. So
yeah, crazy, right? We flipped the calendar. So now there's a whole lot, there's a whole lot of things for us to be considering on strategy and where to play from here.
And am I right that the scores, all of the scores changed a little bit in this past week to reflect that seasonality?
Absolutely. So members, free link below, right? So members, you can go on to Limelight Alpha, Seeking Alpha, Limelight Alpha, top stocks for tomorrow. And you're going to be able to now see the scores reflecting historical second quarter seasonality. So we do that usually either the very final days of the calendar quarter or the very first days of the calendar quarter. This year, it just so happened to coincide that right now, all the scores that will go up in the reports that I post today will reflect the seasonality. So yeah, that's going to affect some leadership. You can see a lot of new stocks jumping in and jumping out.
Yeah, so generally speaking, that seasonality has a pretty big impact on the scores. Is that accurate to say?
I would say that it's enough of an impact where it can start to affect tailwinds or headwinds to a basket. So, I mean, there are certain baskets, like I'm watching healthcare because it's at the bottom of the sector ranking, but it actually has relatively strong seasonality. Sure enough, flipping to the seasonality, it's still on the bottom of the ranking. So no, it's big enough where it can impact it on the margin enough where you should be paying attention to the scores in the first week or two. But I am going to be watching that to see whether or not now we flow through on some of the other metrics, start to attract some positive money flow, and when the earnings reports come out, if they start to look a little bit better, and see whether or not those scores start to travel up over the course of the next few weeks. But yeah, definitely worth checking those reports out today.
Sure. So let's pivot a little bit. I want to talk about the S&P because if you were paying attention yesterday, and even if you weren't, you might have heard about it anyway. The S&P hit 4,000 for the first time, which is an all-time high by all means, and is quite a different picture than what's happening with the Nasdaq right now. So we just wanted to bring that up today and kind of compare and contrast the two a little bit and maybe get some insight on where we're going from here. So take it away, Todd.
Yeah, so I just pulled up the chart. So if you're listening on one of the podcast platforms, we do post these to YouTube if you want to see the charts and be able to see what we're looking at. And Joe, yeah, you can see that chart that I have up here.
Sure can.
Yeah, okay, so this is the S&P 500, and as Joe's saying, we just cleared that 4,000 for the first time ever. I mean, look at this monthly chart. I mean, from the lows in 2009, from 666 to 4,000. Crazy.
That's a thing.
So here we are on the S&P. Amazing period. Here we are in the S&P, and we're clearing out that prior resistance high of 39.8387. We did it on relatively light volume, so we're gonna have to watch and see what happens with volume from here. Oftentimes when we break out, we get a little bit of a pullback and then we accelerate off of it. So it'll be interesting to see whether or not we can continue to just build off of this when everybody gets back on Monday or not. The look of that, though, is quite different than if I pull up the Nasdaq Composite, which you can see on the Nasdaq Composite. We had that peak in February at 14,200, retreated all the way to 12,400, rallied back up to the 50-day, kind of failed, rolled over, rallied to the 50-day moving average again, rallied and fell over. And now we've rallied up and we're testing it again. Maybe this will be the third time as a charm and we'll be able to clear that. But again, the volume is not overly exciting. We have this 50-day moving average resistance. And what's interesting here, Joe, is it's been it kind of reinforces to me that this has been kind of a tale of two tapes. If you were a technology investor, the first quarter was tough. And March, that February, mid-February on period was very tough. And if you were an aggressive tech investor, meaning that you were playing with a lot of, SPACs or pre-revenue stuff or whatever, typically they don't screen very well in our research. But if you were buying those, you really took it on the chin a little bit. And that's quite a different setup on the Nasdaq than we saw in the S&P, which kind of really didn't pull back much at all, 2 or 3%, and then rallied and is now breaking out to new highs. And that's because, of course, the S&P 500 is more of a diversified across more industry sectors that are exposed to different times or in the business cycle. So, I mean, you've got more industrials, more basic materials, more energy stocks, more transport stocks, more other things in the S&P 500 than you do, say, in the Nasdaq 100, which is dominated mostly by, big cap technology type players, or in the Nasdaq Comp, which of course has tons of different technology oriented stocks in it. And, if you were watching the research ranking, technology has been sliding. It's been sliding consistently probably since, I don't know, Joe, December?
Yeah, at least then, I think.
Yeah, and the thing to watch here is whether or not we start to see that re-exert back up the ranking. There are strong individual technology stocks that you can buy, in our research, but the sector overall still has some headwinds that have to clear. And that's very different than, say, if you were looking at energy stocks, which did pull back in the last few weeks. But again, I feel like most of them held their 50-day moving averages and are turning back off of that. But a lot of these other baskets outside of technology, be it industrials or, consumer goods score pretty high for us as well. And some of these other baskets. So I think that the way that, we had this great conversation with Jeffrey Hirsch of Stock Traders Almanac a few weeks ago, and we were talking about the seasonal post-election year tendency or probability for weakness in March. Typically, post-election years, March for the Nasdaq is much weaker than it is in a regular year. And sure enough, we mirrored that. And if you look at that as your analog, it would then say, oh, we're looking good April through at least April, May, and into June, depending on the sector you're talking about or the basket you're talking about. April and May, especially for the Nasdaq, is usually better than usual on the Nasdaq in a post-election year. So I'm kind of, right now, the way I'm modeling, I've been doing my project rotate where I'm putting more stocks into the portfolio from kind of these other areas outside of technology. And then my thinking is, okay, we rolled into the end of March. I spent down all my cash to about 3%, only about 3% left in cash. So I'm positioned, fingers crossed, for a bullish move from here. My feeling would be that that bullish move maybe gets us into May, and I should be starting to lighten back up in May again, raising my cash position up, and then kind of preparing for a tough third quarter. Obviously, that's going to be, dependent on data dependent, Joe, right? But my thinking right now is, okay, so far so good. I deployed the cash into the names that I want. Let's see if these things run for the next 6-8 weeks. If they do, use that maybe to unwind them into prior resistance. Maybe they're old highs, or maybe they rallies up to the 50-day and they start to fall over again or whatever, and sort of lighten up and get myself repositioned towards cash again for maybe a bargain again later in the year. But again, we'll have to see how that plays out.
Yeah, it'll be interesting to see on Monday, because this morning we got just an absolute blowout jobs report. I have it up here. So non-farm payrolls rose by 916,000 in the month of March. So that puts the unemployment rate at about 6% now. So it's I'm bummed out that that the markets are closed today, because it would have been fun to see. I think that we would have had some S&P to the moon tweets. But I'm interested to hear if you think there are going to be some tailwinds for that, or if people are going to forget in another 72 hours or so.
Yeah, I'm not sure how much jobs are driving the car right now when it comes to the market, only because, I mean, the expectation is that, yeah, jobs are going to bounce back as the Fed is actually pumping a tanker full. Now can get the tankers across the Suez. It's so much liquidity, right? Into money supply. And, that is bullish for job growth. And, if you look at our research, Joe, staffing stocks score very high. So, I mean, you could look at something like a Paychex. You could look at on assignment, ASGN is another one that screens pretty high. Manpower screens pretty solid for us. I mean, you could take a look at some of those staffing plays and some of those, kind of payroll providers and stuff. And, hard to believe that they're not going to see some pretty good momentum for their businesses from here. So just taking it on a more granular level. On the macro level, though, I don't know how much of this is already built in. Certainly interesting, though, right? That you a year ago saying, going from a negative 20-something% GDP print and, 50, whatever the stupid number was, craziest unemployment number. I have to pull it up the chart. I don't remember what it is, but unemployment number, to think that we're already back into the sixes on unemployment with a lot of tailwinds suggesting that that employment's going to continue to climb from here. And of course, that's good for wages. That's good for discretionary income. And you can make the argument that that's good for stocks, but it also means, Joe, potential inflation.
Yes, it does. We talked about that in, again, can't remember if it was last week or the week before, but it was the same episode where we talked about GDP growth. And yeah, I brought up the concern, especially among in like the macroeconomist community right now, about inflation and what that might mean. And we kind of just concluded that, well, for right now, there's no real reason to be concerned, but it's certainly something to watch out for, in the same way that when our overbought indicator is flashing, big bright red lights at you, it doesn't necessarily mean, okay, sell everything. It's just kind of it shouldn't be a red light, really. It should be a yellow light, kind of a yield sign, right?
Yeah, everything is more nuanced, right? We should, I mean, there are some people probably that go all in and go out all out, on a weekly basis, or maybe even a daily basis if that's their style. But I mean, I take a more nuanced approach where it's more like trying to turn a freighter, if you will. It's going to take slow, and you sort of direct it kind of opposite of whatever the conventional wisdom would be, and typically that ends up paying off with greater returns. Inflation obviously, ticks up. That's going to make people start to think, okay, inflation is ticking up. That means Powell's going to have to tap the brakes when it comes to money. So, by tightening the Fed funds rate. So, all of those, and since the market's forward looking, so this is where it gets very interesting. This is no longer kind of like the Stan Weinstein stage 2 type market, maybe, where everything is just going and going and going, and you can buy every pullback because it's going to get bought. I mean, at some point, you're going to enter stage 3 and potentially move into stage 4, where you buy those pullbacks, and guess what? The stocks keep going lower and lower and lower. It's another reason, Joe, we love to say this on the show, don't use margin, right?
Yeah.
Don't use leverage, because, I mean, you buy great stocks, and if you're on margin or using leverage, it won't matter. Those stocks fall and they're going to get called away from you, or whatever. You're going to get forced liquidated. You're not going to be able to own them anymore. So I think I think we're definitely moving from that very early stage of the market run into something more mature. And with that, that's going to have to make some people spend some time doing some thoughts, spending some time on their risk management strategy.
Absolutely. Yeah. And one thing I would just add to that is we've said this before and hinted at it many, many times, but just to reiterate, because I see and hear about people doing it all the time. Don't make decisions based off of your emotions. What I mean by that is when you see some news, like you see this jobs number and you say, oh, 916,000, big number. And you go out and you say big number, that means buy, buy, buy. It's like that's caveman talk right there. I'm dumbing it down a little bit, but the point is don't, and more importantly, the reverse of that is when you hear some bad news, people tend to sell, sell, sell. And you see this on Twitter and Reddit and just in social circles all the time. People just they pivot their portfolio to all cash or like all bonds so quickly. And there's almost never a time where you actually want to do that. The other thing I just want to say, Todd, is you owe me a dime for every container ship reference you make from now on. And I'm going to be very rich very quickly.
Yeah, I'll have to ship those over to you.
Oh, there you go. There you go. Perfect.
In a container ship at this rate.
Hopefully it gets here and doesn't get stuck. So I know you wanted to talk about the Arc Space Etf. I think we touched on this back in maybe January or February a while ago, but pun intended, that ETF has lifted off, hasn't it?
I think that what's interesting about this, and it's, you know, ARC obviously has a lot of, let me just share my screen again so you can see this chart, Joe. And listeners, look at that. You know, it's only been trading for 3 days.
To the moon.
20
Space
days.
ETF to the moon.
Yeah. Yeah. So, I mean, I think that, you know, this is very interesting and because it's one of the first in that space. No pun intended.
Oh boy.
Yeah, and I think that, you know, you look at the holdings, that there are some holdings that probably make people go, what? Why is John Deere in a space ETF? And why is Netflix in a space ETF? And, you know, I think that you do have to connect some dots to make that argument, but it's really all about satellites, Joe. So when we're talking about space, we're not necessarily talking about, okay, populating the moons of Jupiter,
we're
right?
Not necessarily like the Virgin Galactic and SpaceX sort of plays, right?
Right. It can be. It can. Space is in there, right? But I think that we have to understand that it also is investing in companies that benefit from from satellite deployment. You know, I mean, if you look at Netflix, Joe, you might get this number. I'm gonna put you on the spot. See if you know it. How many people worldwide do not have reliable internet?
Do not have reliable internet? Definitely not as many as I probably think. I'll go with 2 billion.
All right. So listeners, come up with your own number in your head. 5, 4, 3.
I'm so far off. I know it already.
2, 1. 3.8 billion.
Oh, okay. I can accept that margin of error.
1.8 billion margin of error. All right, you'll accept that. That was astounding to me. You know, that half of the world still doesn't have, you know, reliable access to internet. So you look at that and you say, okay, well, deploying these satellites that can then bridge the gap and provide internet is actually pretty good for the consumption of internet content. And if you assume that it's good for the consumption of internet content, then a natural extension of that, it would be good for online entertainment.
Absolutely.
And therefore, a company like Netflix, where it would, you know, has a total addressable market that is expanding because satellite deployment is allowing more people to access the internet. So there's the argument for that one. John Deere, it's more about in Trimble, which is I'll have to look up the symbol here. Trimble, which is kind of like, they're more based on the navigation, TRMB. They're both more based on the navigation component that satellites allow. So GPS coordinates to control your John Deere equipment in the field. Maybe you don't have really great access to, again, a network that you can use to control these machines in your fields, and increasing satellite coverage would then give that to you. So that's why something like a John Deere would be in there. And then one stock I would call out to investors, because it's very high scoring in our research, is L3Harris Technologies. The symbol there is LHX, Joe. And that's a top 5 holding for the ARC, for for the Arc Space ETF as well. So if you're looking for, hey, what are some stocks in there that maybe I could tuck in my portfolio that also screen really well in limelight stuff, then L3 Harris Tech, LHX would be one that I would throw in the mix.
Yeah, so based off of what you've seen in the obviously extremely bullish movement from ARC over the past, what did you say, 3 days? Is that can somebody be confident investing in that right now, or is it just so crazy volatile that you wouldn't touch it with a 10-foot pole, or somewhere in between those two?
Yeah, it's all about horizon, right?
Absolutely.
If your time horizon is 20 years, then I buy it. I would buy it. I mean, I can't tell anybody else what to do. I don't know their financial situation, right? You know, full disclaimers, right? You know, but you know, if your time horizon is a day or two, who knows, right? I mean, because you know, this is going to be volatile as heck. This thing is going to have days where it's up 6%, it's down 7%. It could get cut in half if the market goes south. And I mean, none of these well, I shouldn't say that. Some of the older companies that are being shoehorned, if you will, into it, they have profitability, they have real businesses or whatever that aren't reliant solely on space. But the strict space plays, you know, those things are still kind of pie in the sky kind of ideas. So I think that, you know, buyer beware, you know, these things are going to be volatile and these stocks could go down significantly. And if you're buying something like this, you're taking a flyer. You're betting on, you know, the industry taking off over the next 10 to 20 years. And I assume there are going to be companies that are 10x companies as far as returns, but I can't tell you when. You know, I have no idea. But it's an amazing potential opportunity. I think there'll be a lot of bumps and bruises along the way, though.
Yeah, it'll be fun to watch, and I'll certainly be watching it. I know you will be too. And yeah, if something if something crazy happens, we'll be talking about it again for certain. So finally this week, we want to pivot into our kind of an alternative smattering of stocks this week. Todd, I know you wanted to pull up specifically the large cap report. So you can go ahead and do that and just kind of walk us through what you wanted to go over.
Right. So on the service, we break the universe up into ADRs, large cap, mid cap, and small cap. And this is the large cap report that we're looking at that gets posted onto that Seeking Alpha, Limelight Alpha service. And you'll see that, you know, it ranks the sectors. So still industrials, financials, REITs, consumer, energy at the top. Not much of change, even with the shift in seasonality. Basics, technology, and healthcare still at the bottom. So that's telling you need to be stock specific in those groups. Where up top, you can be a little bit more fire hosey and grab, you know, general ETFs and everything else. Maybe down below, you want to be a little bit more selective. One of the things that I always like to do, and I would recommend that our listeners who are members also do, is every week we highlight the stocks that are making the biggest jump in score for that current week, so that you can have, you know, a shorter list of new ideas to see if it meets the criteria for your portfolio. So I just want to go through and just highlight in the large cap, because we did just flip to a new quarter. So that has produced some changes in the best and worst ranking for individual stocks. So I just want to pull a few of those up and look at them. And in large cap, the first one that I've got highlighted as a big mover is Equifax. And yeah, I like this setup a lot. You know, you've got a company that's growing 23% year over year in the fourth quarter. You've got that nice little W set up, and it's coming up into the 185 resistance, pulled back a little bit, had a nice reversal day yesterday. Yeah, if you can clear 185 on Equifax, that's looking pretty good. And Joe, 2022 earnings per share estimate is 791, also up more than 20% year over year. So that would be the first one for your watch list that you could consider pulling up. And if I go back to large cap here, and Sempra Energy is the next one. And this not a bad setup either. You've got a cup, big cup here with a handle. Stock's growing for, you know, for a natural gas utility to be growing 8% year over year. That's pretty solid. So utilities, mid single digits to high single digits, that's fine. Earnings per share in 2022 going to 853 from 808 this year. And yeah, so that's another one that you might want to have on your list. Baxter, is another high scoring stock this week, jumped to the past week. And this is a good setup. I actually kind of like this setup a lot, where you have that long base underneath the 200-day moving average, where it kept trying and trying and trying, Joe. And then it finally crossed above the 200, rallies up, and now is retreating back to the 200 at the same time that the 21-day moving average and the 50-day moving average are curling up to cross back over. So it'll be very interesting. I think that's a stock you can buy in the low 80s, maybe 82-ish, 81 to 82 if you can get it. Maybe take it there, because then you could stop out if you're wrong below 80 without a lot of pain. Baxter growing 5% year over year. Nothing great, but nothing bad. But the earnings growth is a lot better. 17% expected in 2022. Another one, I happen to own this one personally, is Centene, CNC. Again, that healthcare space has strong seasonal tailwinds, but the basket itself still ranks poorly in our work. So you really have to be in single stock specific in the healthcare basket right now. But Centene does Medicaid and Medicare Advantage insurance. And, if your assumption is that access to Medicaid and Medicare is going to go higher under this administration, then potentially Centene will end up benefiting. Obviously, there's going to be some puts and takes with the political risk associated with that. But I like the setup. You've got a W setup. It just pulled all the way back to the 200-day moving average. The 21-day and the 50-day are curling up right below it. And again, solid top and bottom line growth for it.
Yeah, one thing I would just add there is I heard earlier this week that they're adding another open enrollment period in August. So that'll be something to watch, and should give a company like Centene some more tailwinds.
Yep, and they do participate in that private marketplace on the on healthcare.gov. Henry Schein would be another one that you might want to pull up in that healthcare oriented space, dental and medical supplies to office-based healthcare practitioners. Remember, Joe, not a lot of people were able to see their primary care doctors or specialists in the past year because of COVID restrictions. As more of us are getting vaccinated and we start to return back to their primary cares, there's going to be a lot of pent up referrals and visits to other doctors and all sorts of stuff that theoretically could boost demand for products sold by Henry Schein. 19% year over year revenue growth in the December quarter. You've got earnings per share going in 2020 to 2021 up about 25%. And then chart formation again is pretty nice. You've got this nice W set up, and you've got this pullback right here back towards the 50-day moving average. And then just looking down here on this list, you can see there's a bunch more. We won't go through all of them, but you can see there's a few different names, more names down here that you could consider. One that you might want to take a look at is Sherwin-Williams. Sherwin-Williams, obviously the painting company. We have rural home sales are very strong, and, people have discretionary money in their pocket from stimulus and higher wages tied to improving job growth. And that translates oftentimes into remodeling. And, that's good for demand for both interior and exterior paint. So you get Sherwin-Williams grew 9% year over year in the December quarter, and 231% EPS growth from 2020 to 2021. That's kind of crazy because of COVID. But you look going forward in 2022, expected to go up about 10%. And then on the chart formation here, I think that what I would want to see, Joe, is if we can close above 254. And then the next down day that you get, buy it off of that. So we move above 254, that gets us into our pivot. Then maybe we pull back towards that 252, 251, and then you could buy it there and go. So I think that's probably a pretty good smattering on how to use those highlighted stocks that show up in our best and worst reports.
Yeah, so there you go. Take it and run this week, everybody. So we're gonna leave it there, and we will talk to you all next week. Take care, everybody.